Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures. Hello, everyone, and welcome to this special edition of Macro Minutes focused on our 2025 macro, monetary policy, and bond market outlook. I'm Jason Daw, your host for today's call. 2024 has been a frustrating year for macro and bond investors. Central banks have cut rates, but bond yields have not declined. But macro nuances have mattered for country allocations. For example, the weak state of Canada's economy has seen bonds outperform treasuries, where in Europe, performance there has matched U.S. Treasury performance, while on the other end of the spectrum, Australia's macro resiliency led to Aussie bonds underperforming, and similar in the UK, compounded by supply concerns. While a good part of global fixed income returns are going to depend on how the U.S. economy evolves and how much easing the Fed undertakes, macro nuances will again be important in 2025. To assess the macro outlook, the evolution of central bank policy, and what that means for the bond market, today I'm joined by my global fixed income colleagues. Aside from myself covering Canada, we have Blake Gwinn on the U.S., Peter Schaffrik on the UK and Europe, and Su-Lin and Robert on Australia. Blake is going to kick off the discussion and enlighten us on, one, why the U.S. economy has been so resilient and if that can continue. Second, how many more cuts are in store for the Fed. Recall that Blake's been at the extreme end of consensus, expecting fewer cuts than the market or consensus, which has now moved in our direction. And third, what this all means for the bond market outlook. So over to you, Blake.
Thank you, Jason. So starting with the U.S., I think it's important to start by saying that the U.S. economy is on a very healthy footing heading into 2025. Consumer and business balance sheets are in very good shape. Corporate profitability is high. Consumption and growth remain very strong. Fiscal policy is and very likely will remain accommodative for the near-term future. Labor markets are slowing, but we're still not seeing any real permanent job losses. Fed cutting cycles underway. And I think very importantly for us, retirements are starting to rise, which leads to a lot of spending down of retirement assets, which is healthy for consumption, but also replacement demand for labor. So if that's the starting point, I think when we look at early 2025, we see some additional tailwinds, particularly for inflation, that are going to start growing into the year. One is simply some pent-up demand following the U.S. election. You can see in surveys and many other qualitative sources like the Fed's Beige Book that consumers and businesses were kind of holding off on large plans, whether that's spending, investment, CapEx, waiting for some clarity on the U.S. political situation for the next few years. With the election passed, they can now start to plan out what the next few years is going to look like for regulation and taxes. And we think that's going to unleash some pent-up activity into the economy heading into early next year. Also on immigration, we've already seen immigration numbers starting to fall from their prior peak very quickly. That's before you really start layering on any potential implications for immigration policy on Trump's presidential victory. That will lead to some upward pressure on inflation, upside risk to inflation in the first half of next year. Also, residual seasonality. We've seen over the past few years that we've had very hot inflation data in Q1. We would expect that residual seasonality is going to show up again in 2025. Now, while this may be a well-understood pattern by markets and the Fed, it does make things a little bit more difficult from the Fed's perspective. This is going to make things look a bit more heady on the inflation side in early 2025, and that will factor in to our expectations on the Fed, which I'll talk about very shortly. Lastly, geopolitical risks. We have commodity prices have remained relatively low. Any kind of escalation in geopolitical risks is likely going to pass through to the U.S. through higher inflation. And we think those upside inflation risks will also be present in the Fed's mind heading into next year. So our Fed call right now, we do think they continue to cut in December and January, despite the fact that we are in a very strong place. I think from the Fed's perspective, they're looking at these broader trends that are saying inflation is still heading back towards 2%, very close to it. Labor markets are cooling. even if that is still towards normalization and not really risks of a hard landing. And so from that perspective, I think they are fine continuing that cutting cycle. So again, cuts in December, January. Now, by the time we get to the March meeting, I think from the Fed's perspective, those tailwinds to inflation that we mentioned are going to start to pick up. Even if they aren't manifesting in higher inflation prints, I think they at least represent upside inflation risks for the Fed. And through their kind of perspective of this balance of risks, where they were seeing a lot of, or at least slightly more downside risk on the labor side of their mandate and very low upside risk to inflation late last year when they started the cutting cycle, late this year when they started the cutting cycle, looking into next year, with those inflation risks rising and with labor markets continuing to stay stable, those downside risks to labor will start to come off. We think it's going to be very easy for them by that March meeting, after 100 plus basis points of cuts, to take a pause. And we think that pause basically extends and they remain on hold for the remainder of 2025, and perhaps even leave 2025 with a hiking bias rather than a cutting bias. In other words, we think things will stabilize. This is very similar to kind of an 89, 95, 98, and I would say even 2019 type of cycle, where the Fed delivers some adjustments, preparing for some potential downside risks. Those downside risks never materialize, and they remain on hold for an extended period of time. So what did we see in those prior cycles? In all of those kind of prior adjustment cut cycles that ended relatively shortly and the Fed went on pause, we really didn't see sustained steepening of the curve. Coming into 2025, I think steepeners have still been one of the more popular positions among market participants. I think a lot of this relies on this kind of historical perspective that says when the Fed is in a cutting cycle, curves should steepen. But with that abbreviated cycle, I think the steepening is also going to be very abbreviated. And we see flatter curves in 2025. I think the front end is going to have to reconcile with this stronger economy, a higher terminal rate that we're expecting, but also the possibility that, as I mentioned, the next phase is actually hiking, that this really isn't just a delay of the hard landing, but a delay that actually ends with another leg higher in the economy. Through all that, I think the long end remains relatively well pegged. We are not big believers in the term premium narrative. Deficits are going to remain high. We do not see this resulting in some big move higher in term premium. And also, when we think about concepts like R star, even though we think the short run neutral rate, because of a lot of these factors we've mentioned, the short run neutral rate is higher and that the Fed's going to end at a higher terminal level, longer run, we still think terminal rates are largely where they have been, over the past 10 to 15 years. So we don't see a major rise in those kind of longer run concept of R star or longer run neutral rates. And because of all that, we do see the long end relatively pegged and most of the yield rise coming at the front end and belly. It would behoove me to kind of mention the election here. We did just have a U.S. election that does pose some risks, and a lot of people are going to be asking how that impacts the 2025 outlook. I will say that most of the impacts from the election are not only very uncertain as to how the platform of Trump will actually translate into policy action, but I would also say that a lot of that is backloaded. I think when we're thinking about our 2025 year ahead, there is some risk to both sides of our forecasts from the outcome of the election. But I think mostly what we're looking at is impacts that would come to pass in 2026, not 2025. Near term, I think on the kind of positive side, on the upside for inflation, upside for yields, it's possible that they push through tax cuts early. We will have that scheduled end of a lot of those Trump tax cuts at the end of 2025. We think they, could preemptively try to roll those over. I would say that rolling those taxes over is probably baked into prices right now. So what we're talking about here is really the possibility that they're much more aggressive on pushing not just a rollover of the Trump tax cuts, but a lower corporate rate, more kind of cuts across the board than are expected. Also on the upside, with regards to inflation pressures and yield pressures, further cuts in immigration. I think of all the potential outcomes of the election, when we're thinking about our rate forecast, this one is not only perhaps the most impactful in the near term, but it's also one of the actions that's most likely, because it doesn't rely on Congress to pass anything in the way that tax cuts do, and even potentially some of the broad tariffs that Trump is talking about would have to go through Congress. Immigration is something they can kind of do on day one and could have some very strong upward near-term impact on inflation. The last, I would say, trade war uncertainty. This is something that is very hard to kind of wrap your mind around what we're actually going to get. Obviously, Trump has talked about some very big, broad, sweeping tariffs on the campaign trail. What actually gets enacted is a lot less certain. Are these tariff talk going to be more bark than bite? or do we see those actually put into place? We don't know, and I'm not taking a strong view on that, but I think what remains true for the near term as far as our forecasts is this is going to lead to some near-term volatility. We are very, very likely to be getting a constant flow of headlines around it, whether that's tweets or statements from Trump about various trade policies. That is going to be something that keeps markets on edge for the near term. So even if we're not baking in the impacts of those tariffs, we have to at least consider the uncertainty in the near term. So I think on net, when we think about the impacts of the election, it's not something that we're really baking in to a large extent in our modal forecast, other than the expected rollover of those tax cuts, continued kind of gradual declines in immigration. But it does represent some risks, and there are risks to both sides of that outcome. Probably a bit more on the kind of higher inflation side, higher rate side, but that's kind of how we're viewing it. Only in the balance of risk, not really changing the modal outcome for 2025.
Okay, thank you, Blake. Unlike the U.S., that's been a source of strength, Canada's economy has been much weaker, and I'm going to focus on the reasons why that will probably continue and what it means for the Bank of Canada and the bond market. So to provide a little bit of context, the Canadian economy, it has struggled the past 2 years as high interest rates collided with a highly leveraged household sector, ongoing anemic business investment, and declining commodity prices. And when you look at 2025, there is a trifecta of headwinds that suggest below trend growth should persist. The first is mortgage resets. They're going to be marginally more painful in 2025, both in volume and price terms. The second headwind is U.S. growth. So as Blake mentioned, strength in the U.S. economy has been pretty decent. It has been a tailwind for Canada. And even though a soft landing is more likely than a hard landing or recession, if the delta on U.S. growth turns less favorable, there will obviously be some consequences for Canada. The third headwind is changes in immigration policy, and that could shave a decent amount off growth over the next 2 years. The new government targets are quite aggressive, difficult to see them being fully implemented or materializing. But regardless, immigration will shift from being a positive to a negative impact on growth. Then on the inflation front, based on the current and future growth conditions, there is a higher possibility, in our opinion, that inflation dips below 1% in 2025 instead of it being above 2%. We've had excess supply in the product market, excess supply in the labor market. And when you couple that with dynamics in mortgage interest costs, there should be a strong downward bias to inflation over the next year. For monetary policy, our opinion is that the Bank of Canada is more behind the curve than ever before in an easing cycle. Usually, they are cutting well before the economy gets into excess supply, but this cycle they've been very late, which was necessary to squeeze inflation out of the system. And to put it in context, if we were in a low and stable inflation cycle last year, the Bank of Canada would have probably already started cutting rates last summer and maybe already completed the easing cycle by now. So in our opinion, disinflation risks won't dissipate until excess supply is absorbed, which requires a period of sustained above-trend growth. For that to occur, we think policy needs to move into accommodative territory. Our current forecast is for the Bank of Canada to lower the overnight rate to 2% by the middle of 2025, and the risks are probably skewed to even more cuts rather than less. Moving on to the fixed income outlook, we think 2025 should be a self-reinforcing cycle between macro and policy that leads to lower bond yields, marginally steeper curves, and GOCs outperforming treasuries. Markets surely won't move in a straight line, but we think the macro forces are strong and any counter trend moves should be faded. Now, history is on the side of owning fixed income. In most easing cycles back to the early 1990s, Canadian fixed income total returns have been between 5 to 15%. The exceptions are small cutting cycles, such as 1998 and 2015, or a situation like 2020 when rates were cut from already low levels and inflation was high and volatile. Now, when you look at the fundamental factors, they are supportive of duration. Specifically, two main drivers of bond yields, policy rate expectations and pricing, and macro growth and inflation. Those are slanted towards a favorable environment for bonds with a high margin of safety, in our opinion. The next 50 basis point move in 10-year bond yields, we think, is decidedly skewed to the downside. Now, from a cross-market perspective, the divergence in Bank of Canada and Fed policy, that can possibly reach post-inflation targeting limits. I think it's important to remember that the only episodes over the past 30 years where policy cycles were very aligned between Canada and the US was during common shock episodes, such as the 2001 tech bubble, the commodity boom leading up to GFC, and into and out of COVID. Absent an unforeseen development, the Bank of Canada should be able to forge its own path. And specifically, we think that the rate gap between the Bank of Canada and the Fed could reach 200 basis points in 2025. One question that we often get is the currency. In our opinion, it's not important yet. You really need to see a large currency depreciation to materially impact inflation. But with the starting point right now pointing to disinflation and possibly undershooting the inflation target, that means the Bank of Canada can be more tolerant to FX weakness than they have in the past. And this is consistent with the message recently by Governor Macklem, who said that the Bank of Canada and Fed divergence is nowhere near stretch levels. Our currency team, they expect dollar Canada at 143, and that's based on a 200 basis point gap between the Bank of Canada and the Fed. And we think it probably needs to be above 145 before it would really start to impact policy decisions. On cross-country bond market performance, no matter what, Canada cannot escape the gravity of U.S. Treasuries. But divergence in relative macro fundamentals has and can continue to support a notable drift. For example, this year, Canada-U.S. spreads, they moved deep into negative territory, and we expect this trend of Government of Canada bonds outperforming to continue in 2025 as macro forces remain more conducive for large-scale cuts in Canada. As far as the curve, it should steepen, but not as much as past cycles. Consistent with history, every segment of the yield curve has been on a steepening trajectory since the Bank of Canada embarked on its easing cycle. Our forecasts envision further steepening from here, with the degree dependent on how much the Bank of Canada cuts relative to market pricing. If our 2% terminal rate is achieved, on a carry-adjusted basis, 5s, 30s, 10s, 30s, they probably offer the most compelling opportunities relative to other parts of the curve, such as 2s, 10s. And lastly, I want to highlight two political risks to our outlook. On the Canadian side, according to the polls, it's a matter of when, not if, there'll be a change in federal leadership. Right now, the Conservatives are set for one of the largest mandates in history. Whether there will be marginal or larger scale policy changes, that's difficult to predict. But in general, there could be some consistent chipping away at the policies over the past 10 years that the Liberals and NDPs put in place. The clearest changes would be probably less tax and less spending. Other areas where changes could be afoot are on climate, carbon tax, energy, regulation, pipelines, immigration, foreign competition possibly. Growth and inflation impacts are definitely murky, but there is the potential for more business-friendly policies that could help mitigate some of the severe underperformance in Canada business investment and productivity on an absolute and relative basis to the US. Now, the Conservatives do appear more inclined to pursue a balanced budget, but the timing of achieving it would be uncertain. With our budget deficit at only 1.5% of GDP, the impact on issuance would be minimal over a multi-year horizon. Now, on the US political side, Trump is threatening tariffs. There is going to be heightened levels of uncertainty in 2025 and beyond. The consequences for the economy and market in Canada, definitely important. Canada benefits greatly from its close trade relationship with the US. But as Blake mentioned, we think Trump's bark is going to be bigger than his bite when it comes to Canada. Canada has a lot to lose, but so does the US. So we assign a very low chance that across-the-board tariffs would be put on Canada. And if they were, it would probably only last for a short period of time. Now, targeted tariffs, they're probably more likely. But our base case is that the threat of tariffs or the US exiting USMCA will allow the US to extract enough concessions to prevent the extreme scenarios from unfolding. So in our base case of no across-the-board tariffs, there's not really any policy implications for the Bank of Canada. If there were substantive tariffs applied, and given the current state of the economy, it would probably necessitate more rate cuts rather than less from the Bank of Canada. So moving over to the UK and Europe, the Bank of England, they've cut twice, the ECB 3 times. Is this enough, Peter, for the current and future state of affairs for the respective economies? Please tell us what's in store for 2025 on the macro policy and bond market front.
Thank you, Jason. Obviously, towards the end of this year and at the time as we're recording, there is potentially large changes underfoot both domestically as well as stemming out of the US. But before we discuss those, let's discuss what we actually do know. When we look at the euro area first, what we see is an economy that has not been performing great, but where still the expectation is probably worse than the actual outcome, as we've just seen with the latest growth numbers that have been released. However, when you look at where the growth is coming from, it has been predominantly from people being brought in employment, particularly in the south of Europe. Productivity growth has been very weak, and there's very little to expect that this picture is going to change quickly. Therefore, as we look towards 2025, and as we see levels of unemployment approaching that should be equated with full employment, it seems difficult to have the same kind of growth trajectory, or rather origin, as was the case in 2024. And with the lack of productivity growth, it seems difficult to keep even that kind of growth pattern that we had, mediocre as it was, going without creating inflationary pressures. Therefore, the question is, will the economy slow down even further? Or more likely, will it stabilize around current levels as the ECB cut rates and we are returning to an environment where wage growth remains relatively ample, and we're talking again about domestic inflation pressures, which we think is more likely. Add on top of that potential changes through tariffs or other policies that on balance are probably going to be negative for Europe, but are also probably going to be inflationary, and the problem could be exacerbated. What does that mean for the ECB? We have forecast 25 basis point rate cuts consecutively until April, and the terminal rate, therefore, at 2.25 percentage points. That is higher, although not significantly higher than what the market is currently implying, and we feel quite comfortable with that. It remains to be seen whether any significant policy changes, particularly on the tariff front, is going to be so negative that the ECB would have to cut much deeper, and indeed if the labor market loosens. But our base assumption is that neither of those is going to happen, and therefore we can see the ECB plateauing round about the middle of the range that they consider neutral, at about 2.25, as I suggested earlier, and then adopting a wait-and-see approach. What also needs to be considered is that we get domestic changes from the political front here in Europe as well, particularly with the German elections coming up. And one of the elements that should be considered is that, just as Jason was outlining in any potential changes in political leadership in Canada, one of the other elements that should be considered is that there's likely going to be political leadership changes afoot here in Europe as well. Most notably in Germany, where elections are going to be held now in February, and we'll probably get a shift to the center-right. And with that are probably going to be some policy changes, particularly as far as energy policy is concerned, migration policy is concerned, and probably fiscal policy as well. That could, if anything, change the outlook slightly to the better, which again would be exacerbating the potential domestic pressures that I've outlined already. What does it mean for the bond market? It seems difficult, even at these mediocre outlooks for the economy, to get bullish bonds. Particularly the longer end of the curve is also pressured by ongoing QT pressures from the ECB. And we've already seen a significant underperformance of government bonds relative to swaps in particular that have put upward pressure on bond yields as well. We don't see a significant sell-off, but we don't see a bond bullish environment unfolding in Europe. What about the UK? Now, the situation for the UK is very similar, but there's one key caveat, or at least one key caveat. We recently had a budget in the UK that has expanded the fiscal stance quite substantially. It was the first budget of the new Labour government, and it has certainly surprised to the looser end. The Bank of England has taken account of that. Yes, they have cut rates, but they have acknowledged that a looser fiscal stance probably means a stronger economy and a more gradual return to the inflation target. It seems likely that the market's reduction in implied rate cuts from the Bank of England is relatively accurate. Particularly if the economy at the end of the day continues to chug along at a relatively tight labor market, very similar to the situation that I've just outlined for the euro area. And domestic inflation pressures do not recede as quickly as we're previously expecting. What does that mean for the UK bond market? We've already seen a significant repricing from the front end, and the back end of the curve is already hovering somewhere between where the euro area is being seen and where the US is going. At the end of the day, the UK is even more at the mercy of where treasuries are going than the euro area, because the Bank of England's leeway to cut rates is probably even smaller than that for the ECB. We think there's probably going to be some steepening of the curve, and the risk in the UK of a increased term premium is probably higher than in other markets, because markets are already on tender hooks when it comes to the UK's fiscal outlook. As a summary, therefore, the outlook for Europe is certainly not great, and the implications from the Trump election have downward pressures, for sure. The question, however, is whether that translates into significant rate cuts, and we have our doubts. With low productivity growth and domestic tight labor markets, that means inflationary pressures remain there. And with a potential loosening of fiscal policy, or an actual fiscal loosening in case of the UK, that pressure is, if anything, only going to be bigger. We find it difficult to be bullish on European bond markets and think that the risk for yields is slightly to the upside. The risk for the curve is for slight steepening. And certainly the risk for asset swaps is probably still on the underperformance for government bonds relative to swaps.
Thank you, Peter. Very insightful. Australia has been the odd man out in the 2024 rate cutting cycle, but Su-Lin and Robert are going to tell us why that might change in 2025, along with the implications from domestic and U.S. politics.
Will the RBA finally join the global rate cut party in 2025? How will a federal election by May of next year impact the economy and influence the bank's thinking? What are the possible consequences of a new Trump administration? And what does this all mean for fixed income? These are just some of the key macro and rates themes that we're thinking about as we move towards the new year. So the Australian economy is running at a pretty sluggish pace into the end of 2024. We expect GDP for the year of around 1.25%. That's another sub-trend year of growth, and it largely reflects a weak consumer following a sustained period of negative real household disposable income through to the middle of this year. We do think, though, we've passed the low point in growth, with activity likely to pick up modestly in 25 to around 2.5%, reflecting three key drivers. So the first one of these is around household consumption, which we do expect to lift in 2025 to around 2%. That would still be below the long-run trend and soft, but the across-the-board income tax cuts effective from 1 July this year, coupled with lower headline inflation, is helping to lift real incomes. There is obviously a lot of debate over whether households will spend this additional income or save and pay down debt, but we think there's scope to do both in the year ahead. At the aggregate level, households are barely saving, with the household savings rate at just 0.6%, and that's well below the long-run 5% average. Our expected pickup in activity overall is largely dependent on a firmer consumer amidst what is likely to still be a reasonably healthy labour market in 25, some real wage growth, and some, hopefully, modest easing from the Reserve Bank. Secondly, we expect public demand, especially government consumption, to remain strong. It's been a key contributor to activity, keeping GDP positive for much of the last couple of years. Around 80% of this public demand is government consumption, and it's concentrated in areas like health and social assistance, education and defence. Australia has a particularly large government program called the National Disability Insurance Scheme, the NDIS, and that has been quite a key contributor to government expenditure. Public demand continues to rise as a percentage of GDP, and at just over 28%, it's at record levels outside of the COVID period. We have a federal election due by May of next year, and the government is consistently behind in the polls. It is likely then that fiscal policy is more expansionary in 25. There are clearly parallels to the recent US election. Cost of living remains a key issue amongst voters, and we do expect further measures to be announced in the coming months, either at the mid-year update in December or possibly an early federal budget in March of next year. And thirdly, there are some encouraging signs in residential construction. Most of the leading indicators have stabilised, albeit at decade-low plus type levels, and are starting to turn upwards. There are obviously a whole lot of challenges for housing construction. We still have pretty elevated material costs, shortages of labour, long approval times, and some fairly costly inbuilt taxes. But the data suggests that it should start to stop dragging on activity further into 25, with some uplift likely, and that will be very welcomed given the continued shortfall in supply. The risks to our modest but firmer growth outlook for 25 are balanced, but we are mindful of the potential challenges to Australia from a Trump administration next year. It's obviously early days, and there's clearly a lot of uncertainty around exactly what policies will be enacted and the time frame, but the imposition of across-the-board tariffs of 10 to 20% with 60% on China and the risk of retaliation is front of mind for us. As our largest export market and trading partner, weaker Chinese growth, as well as weaker global growth, plus more inwardly focused economies and reduced global trade bodes poorly for an open economy like Australia. The lagged impact of weaker activity should see some softening in the labour market in 25, but we note that the starting point is stronger than we thought across multiple metrics that we've spoken a lot about on macro minutes throughout this year. In particular, we've been surprised by the persistent outsized gains of monthly employment generation, with the strength of government spending in health and the NDIS, which is spilling over to a lot of health and social assistance jobs. They now account for around 15% of total employment and rising. The unemployment rate has lifted from a 50-year low, but at a little above 4%, the labour market remains tight and a global outperformer, especially versus its dollar block cousins like Canada and New Zealand. The leading indicators of employment do suggest some moderation in the labour market next year. But with most of the vacancy data staying above pre-COVID levels and ongoing public demand, we look for only a modest lift in the unemployment rate to a 4.25% to 4.5% range for much of next year, not far from full employment and still low by historic standards. Some loosening in the labour market, including hours worked and the pace of job creation, should see a cyclical lift in productivity, helping bring underlying inflation just back within the RBA's 2 to 3% target by the second half of 25. At 3.5%, it has moderated, but it's still a little high, and key components, especially services inflation, is still pretty sticky, and it's moving sideways around 4.5%. This is key, obviously, for the RBA, which, unlike the rest of the dollar bloc and Europe, has remained patiently on the sidelines, with the cash rate unchanged at 4.35 since November of 23. Having not taken the policy rate as restrictive as most other countries, the hurdle to cut has always been higher, and the easing we expect in 25 will also likely to be much smaller by global standards. Our base case is for a modest 75-point easing cycle beginning in February. So we've moved back to a base case of just 50 basis points of adjustment cuts by the RBA from May of next year, with 25 basis points in May and 25 in August. That would take terminal to 385 on the mildly restrictive side of neutral. A labour market that's not far from full employment throughout most of next year, the likelihood of more government spending and some inflation challenges, including globally, as a new Trump administration begins, argues for ongoing patience from the RBA as we move into 2025. Rob, I'll hand over to you for the market side.
Thanks, Su-Lin. Turning to fixed income markets, while a Trump victory in red sweep might keep some marginal upside pressure on yields and curve shapes, much of this appears to have already been priced in pre-election, and Australia's followed the move to slightly lower yields and flatter curves over the last few days. We think this fading can run a little further, even with the RBA still some way off actually entertaining cuts. So our base case is yields slightly lower into the back end of this year, and a slight drift lower over 2025 too. We've only just got over 50 basis points priced in at the moment for the RBA's cutting cycle. We're not expecting a return to the 130 basis points, which was priced in mid-September. But with further hikes not a realistic possibility, we think there's more room for a cut pricing to return than there is for it to fade further. On a cross-market basis, some likely additional inflationary and fiscal pressure in the US, coupled with increased downside risk to Chinese growth, means that Aussie-US spreads deserve to trade a little tighter. The benchmark Aussie-US 10-year bond spread is currently around 25 to 30 basis points, which looks a little higher to us. It has scope to trade, we think, towards the bottom of a 0 to plus 30 range in 2025. Greater fiscal risks in the US should also mean less AUD swap spread tightening relative to US next year.
Thank you, Su-Lin and Robert, and thank you everyone for joining this special edition of Macro Minutes to hear our thoughts on the 2025 outlook. Macro and rates will continue to be a main driver of all asset markets next year, so please reach out to us or your sales coverage if you have any additional questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.